This is the briefing for Friday, May 16th. Well, the S&Ps, the spiders, certainly had a decent day today in that they broke out to the upside of the two-day rotation that they were in. You can see this rotation right through here. This is a 60-minute chart of the spiders, 60-minute chart of the Qs, and a 60-minute chart of the Russell, the IWM. So you can see this is today's trading in the spiders. You can see the breakout that we saw right through there. Volume was pretty low in today's trading. You can see we didn't quite break out. There's a rotational pattern in the Qs. You can see we did not take out the previous day's high. And in the Russell, we've been in this rotational pattern for probably 5 days of trading for most of this week. So I've got these trend lines set up with alerts set on them. So this is going to be very important lower key reference area of 500 in the Qs, right around the 576 area in the spiders, and the 205 area in the IWM, mainly because if we trade back through those areas, it's certainly going to give us the opportunity to test the lower key reference areas, and potentially that would suggest a greater degree time and price counter trend rotation. Now, also, as I talked about in last night's briefing, you can see this area at 585 in the spiders right through here. If you're trading short term, that would be an opportunity to short below 585 with a potential for knowing that potentially support comes in at this 576 area. Same thing with the Qs, a break of that area of rotation. And of course, I've got the alerts set up here for the Russell to be long above about the 209, 210 area, and then if we do get a rotation back to the downside, support comes in at 205, and I certainly want to look to be short below 205. Now, this gap, you can see this gap starts here in the spiders and goes all the way up to here. In the Qs is about the same thing. Same thing with the IWM. Now, that gap represents convictive buying. Convictive buying basically is a lot of traders put orders in prior to the open, thinking that the market was going to go higher. And of course, when those orders hit the market, they hit the market at a higher price, not opening where it closed the previous day. So that's convictive buying. If that were to be retraced, and the way I look at it is if it's retraced about halfway, it's going to get completely retraced. So this lower key reference area short term is going to be really important should that happen. Now, I'm not saying it's going to happen, but should it happen. The positive thing that's happening here, and for those of you who haven't listened to this briefing this week, these yellow lines are now what I've come up with is net volume, which is up volume minus down volume. So even though volume was fairly low in today's trading, you can see that up volume was really dominating the day in terms of the NYSE. In terms of the NASDAQ, you can see basically the same thing, 4.5 million more shares trading higher as opposed to lower, and I should say in terms of volume. And then, of course, in the Russell, 1.488 million more up volume as opposed to down volume. Concerning to this all right now is market breadth. This is S&P 500 breadth. So we had about 388 shares positive, which was good. And on the NASDAQ, only 1175 were positive. Probably one of the reasons it didn't have enough fuel to break yesterday's high. And of course, only 477 in the Russell. That's why it's stuck in this area of rotation. Now, looking at the daily chart, you can see volume is flat, but the positive side of it, as I just showed, is the fact that whatever volume we had in the spiders or in the NYSE was most of it was up volume as opposed to down volume. So right now, we're above trend. The trend in price is up. We've had a couple days of pause, so it looks like next area of resistance is 610. This is still concerning me. This breadth divergence with price. So this slope should be going the other way. But the other internals are strong, and really this is a broad-based rally that we're seeing, at least right now. Same problem with the Qs. NASDAQ is diverging. You can see NASDAQ breadth is diverging. Volume is still extremely low. So between volume being low, although even though it is mostly up volume, and the breadth divergence, I still have some issues with whether this rally is sustainable and how sustainable it is. But right now it appears that we're going to test the 540 area. These are the all-time highs and potentially take them out. The Russell finally appearing to want to break out of this 4-day area of rotation. Next upside resistance is going to be 214. You can see here that breadth is in the Russell is declining as well. But I have to respect the trend in price, and the trend in price is up. And what makes me feel much better about it is seeing what's happening with up volume as opposed to down volume, at least on an hourly basis in the market. In terms of overbought and oversold, we're basically neutral in the NYSE and approaching an overbought condition in the NASDAQ. But certainly this doesn't preclude the market from continuing higher the first of next week. Now, as I've said over the past couple weeks, this market is driven by news events. And right now, the news events that are coming out are fairly positive, even on the economic front, and certainly in terms of the tariffs. But with that being said, because of the low volume, and that volume suggests potentially that the big money is still standing aside, it suggests that if there is any bad news that hits the market next week, that we could see a turn down and we could see a pretty good decline before we see some type of pause and or rotation back to the upside. So we have to be long this market at this point in time, but we want to be long with caution. And we want to certainly know where the important key reference areas are in terms of support, because if they're broken, then you may want to lessen up or even terminate, or terminate's a bad word, or exit your long positions and see where the market is going to find a floor. Now, this is really surprising. This is the percentage of stocks above the 50-day moving average in the S&P 500. This is the percentage of stocks above their 200-day moving average in the S&P 500. So you can see we've had an explosion above the 50-day moving average. I mean, you can see down here, this was April 4th. So about a month and a half ago, there was only 10% of the stocks in the S&P 500 that were above their 50-day moving average. And now it's approaching the 80% are above that. And in the 200-day moving average, we're up to 53%. So this is telling me it's a broad-based rally. In the NASDAQ, 64% are above the 50-day moving average. And then that's coming from about 13% on the April 4th that were above the 50-day moving average back during the decline. 200-day moving average, the NASDAQ is lagging some in terms of that in comparison to the S&Ps, but certainly this is very, very promising. Same thing with the Russell. Russell percentage of stocks above the 50-day moving average in the Russell, almost 70%, coming from a low of 7, about around 7% in the Russell, and not quite approaching trend in the 200-day moving average. So you can see the rally is broad-based. Up volume is certainly improving in terms of the daily basis. So even though we're in a pause, which we expected because we had reached a point of being overbought, and we know that markets run and pause in all degrees of time, it would be important to keep in mind that the trend is up. There are certain internals within the market that are supporting this trend. Little concerned over volume and the divergence in market breadth, but like I said, that can get eliminated very, very quickly. but keep an eye on the short-term key reference areas, because those are the areas where you're going to want to consider either putting stops and or exiting positions if there happens to be some bad news that comes out next week. That's about it for this week. Have a great weekend. I'll pick this back up on Monday for subscribers.